Good morning. I'm having the usual issues with setting up. I apologize. It just seems like it's the way it's going to be until I figure out what's going on. If anyone is familiar with OBS and working with, what do I call this? I'm working with an iPad. Anyway, let me know so maybe I can ask you for some advice, but I just have to reboot everything right before I go on, no matter what I do. All right, let me see. So today we are going to begin the capital budgeting. I gave you a lot of material to review techniques of valuation. I don't think there's anything new that I have to say. It's just a matter of you practicing, rehearsing those problems. And I'm going to give you some more problems in Connect as well. And then maybe some sort of prep questions. I don't know. I think you have everything you need for that right now. I'm going to start capital budgeting, and you'll have a whole set of other problems to work on. So you have quite a bit to do. So I wanted to start capital budgeting with the document called UAIR case. So this is really long, lots of reading. If you're not a reader, you need to develop a strategy. If you're not, I consider myself a slow reader, and I have to keep myself alert. I use colored markers to help tease apart the elements of a case so I can tackle it. So I suggest you find your style. The more practice you have, the better. On the test this weekend, there'll be a case, and I will distribute different cases to different students. So there'll be several different cases. All right. So also you'll have questions on the techniques evaluation that we did yesterday. Okay, so what we're going to do, how we're going to start is we're going to read the case, and you should have learned capital budgeting in 3106. Our goal is going to be for us to derive the cash flows. So that's the first, what we're going to do is like the more simple capital budgeting type questions you've done in the past. I'm not going to just give you cash flows. You have to determine the cash flows with the information I give you. All right, so you're basically going to make up the schedule of cash flows. Now, I'm not leaving you out. I'm not leaving it up to you completely. I'm giving you guidance, and I'm giving you information. And obviously, there's a lot of other things we could have put into deriving the cash flows, but work with what I've given you for now. Okay, so this is an attempt at getting more realistic, because as a financial advisor or analyst, or being part of a management or a finance team, you don't get someone feeding you information. You have to ask or dig for the elements that you might need. So this is just a start to doing that sort of a thing. Okay, so capital budgeting. So we begin. Here's the case. So this case, I'm going to present it now this week, and we're going to use it and answer a couple of questions referring to it, and then next week we're going to reintroduce it and ask other questions. So you're going to see this a lot. So UAIR is a hypothetical leading American airline which transports passengers, cargo, and mail to 63 cities in North America. UAIR provides jet services to cities located in the US, Canada, Mexico, Europe, and the Middle East, and the Caribbean. Revenues last year totaled $5 billion. So as we read this, any cash flows or any amounts that are mentioned, we have to identify if they're cash flows, and in particular, are they incremental cash flows? Incremental cash flows would be, in this case, cash flows that accrue as a result of taking on the project. So cash flows that either are accumulating they're positive cash flows, or they could be expenses or negative cash flows. So this is the first one, the 5 billion last year. So this is my first question to you. Is this an incremental cash flow? So the definition again of incremental cash flow, it's a cash flow that occurs as a result of taking on a project. How many of you think this is an incremental cash flow? No comments? So we think if we don't take on the project, would our revenues still have been 5 billion last year? If we do take on the project, will our revenues have been 5 billion last year? So because this is past, this has nothing to do with our project. This is not an incremental cash flow. So I can just scratch it out as not relevant to my capital budgeting. So if you don't know what I'm talking about, that's okay. You're going to understand by the end. And you're going to have to do a lot of these, so you're going to get experience. I see, I can't. Oh, next. The airline is considering opening a new line to the Bahamas. Last year, UAir hired a consultant to prepare a test marketing at a cost of $2 million. Again, last year. Is this an incremental cash flow? No, Alfonso is right. No, Alex is right. It's not an incremental cash flow. This is known as sunk cost. This is an amount that we've already spent, whether we take on the project or not. Doesn't matter, we still would have spent that money. So let me make even though I'm crossing them out, let me make a note on the side. So we just, in case somebody asks about that amount, we have discussed it. So that's sunk cost. Right? Very good, Sarah Monica. Okay, next. Given the competition in the air, so why I'm doing this, I'm reading through it and making the notes off right immediately so I don't waste time. Okay, you don't want to be wasting time reading and rereading and rereading. So right off the bat, make notes as you go, and you can then read your notes and see if you missed something else, missed anything else. Given the competition in the airline industry, the consultant recommended to maintain the new Bahamas line for only 4 years. Important data. So this I will put as, I'll use red. So we need this 4 years. So the project is going to have a 4-year horizon, 4 years. Very important. Her Her predictions indicate that UAir can sell 16,000, 24,000, 30,000, and 22,000 round-trip tickets to the Bahamas. Okay, what would we call these? Do you guys think of a... We need a little bit more information because these are the ticket sales that will result during the first, second, third, fourth years. The consultant recommends that UR will charge 2,000. We need that too because these two together, these two sets of information together tell us what? What do we call that? Are these, first of all, are these incremental cash flows? Well, will this comprise incremental cash flows? They are cash flows. So if I put these together, 16,000 tickets at $2,000 each is 32,000. Sorry, it's $32 million, right? Because I have 3 extra zeros here, and I already have 3, so I'm going to have 6 zeros and then 32. So that's 32 million. And then here it's going to be 48 million, and with the third year, it will be 60 million. In the fourth year, 44 million. What do we call that? It's an incremental cash flow, but particularly it's known as incremental, I'll just use inc, incremental revenues. Incremental revenue. Got it? Right, the number of tickets times the price per ticket will make an incremental revenue. So I need those two pieces of information together. Write it down. Okay, let's continue. Sorry if I make you dizzy. She forecasts that if UAir chooses to launch the new Bahamas line, it will compete with its flights to other destinations in the Caribbean. Okay. As a result, UAir will lose sales of 100, 200, 400, 300 round-trip tickets to other destinations in the Caribbean during the first, second, third, and fourth years of the project, respectively. The estimated round-trip ticket is also $2,000. So what are these? What do we call that? Okay, so they're negative cash flows. They are cash flows. And we refer to them as incremental because they're a result of taking on the project. We are going to lose tickets because people will go to Bahamas, right, instead. So that's what they're estimating. But there's a special name for this phenomenon. This is called a side effect of the project. Side effect. And it's a it's a negative side effect, right? You can have positive side effects. This is a negative. Detrimental revenue. I've never heard that term, but it is a detrimental, well, I don't know detrimental revenue, but it would be incremental cost or incremental cost, yeah. It's a loss. So it's a side effect and an incremental cost. So we'll put those together. We're going to put all this together. I'm just making notes for now, right? UAir's CFO and his aides estimate that the company's average variable operating costs per round-trip ticket to any Caribbean destination, including the Bahamas, is $1,000. Okay, so what is this all about? Is this relevant? What would we call the $1,000? Is it incremental? Because we're going to take on the project, we're going to sell tickets, but then to offer those services, it's going to cost us something, right? So those are only going to happen because of the project. So we refer to those as incremental expenditures. Let me divide these up. So this one would be incremental expenditure. Or I'll say expense, so it fits. So that's an incremental expense. So we have revenues, but we have expenses. So we're going to have to get the net revenue at some point. Exactly, their net revenue, not profit yet. Well, yes, I guess on the flights. Right. So the net revenue, net profit. There's other expenditures, so I don't want to call it profit yet, but on the flights, it's the net revenue, yes. Okay, so then they note that since the airline has a vacant terminal, this is important. Well, it's all important, but this might be tricky. The airline has a vacant terminal. There is no need to rent an additional terminal for the proposed Bahamas line. So that's how it works, right? Airlines rent space and they pay a rental cost, and when you land a plane they have to pay for landing costs, they have to pay for sitting, so every time flights are delayed, that costs the airline. But anyway, that's besides the point. So they don't have to rent. So this airline does not have to rent. They actually have a vacant terminal. But we have to take into account that even though it was vacant and even though it's not being used, there's opportunity there. There's a market value for that terminal. If the firm decides to use it for the Bahamas line, that means that it is no longer available for rental to other airlines or for other purposes of their own. So there's an opportunity cost to taking this terminal and using it yourself. This $10 million that it's mentioned that the rental cost of a similar terminal is $10 million. We have to account for that in terms of cash flow. We're not going to receive that. So that we call, I'm going to put it over here, this is the opportunity cost. And you can't see that, can you? I'll make it bigger. $10 million is known as opportunity cost. And it's an incremental cost. It's an incremental cash flow that has to go into our analysis. Okay, so continuing. So we've done most of it. We've done half. Let's keep going. The airline vice president, customer service and operations determined that for the predicted ticket sales, the airline must purchase 4 new airplanes. UAir's purchasing department has decided that most suitable airplane for this line is the DC-9. The cost of a new DC-9 is $10 million. And then it mentions about the IRS. IRS includes airplanes in the 7-year depreciation period. The maker's table indicates that 28.6% is appropriate double declining balance depreciation rate, 1/2 that, or 14.3% in the first year. Okay, so until the switch to straight line depreciation in the 5th year. A DC-9 lasts 30 years before it's scrapped. Okay, so then, all right, so this whole phrase, you've all done your accounting, you're familiar with what to do with this. So in terms of cash flows, what we have to do is account for the fact we're going to buy some planes. Now the planes, while we have them, are going to deteriorate. There will be wear and tear on the planes, and that is, looking from now into the future, that is an expense. That's a loss. That's a cost that we can deduct from taxable income, right? So we want to account for the purchase of the plane, the depreciation that we can claim. Although depreciation isn't a cash flow, revenues, tax savings result from being able to depreciate. So that is a cash flow that we have to include. And then at the end of this project, we're going to sell the planes. And selling the planes, we're going to sell the planes for this amount, but we have to consider whether selling the planes for this amount after we've accounted for depreciation would look like a capital gain or not. So we have, this whole paragraph has to be sorted out. But essentially what we have there are incremental expenses. There's some incremental revenue in here that we're going to manage because of the effective depreciation. So we're going to manage this portion separately. That this has to do with the investment. Okay, so I'm going to show you how to do that if you don't know. Or we're going to use the maker's table that I've given you. Now, use the one that I've given you that I've derived from the IRS website. I can't remember where I got it, honestly, but I think I pulled it out of there. There's also one that, I think there's one that's linked to the textbook, but since my solutions work with the one I'm giving you, let's work with that. It's 3 decimal places. How many of you have not worked with the maker's table before? Who's not worked with the maker's table? The maker's table is elegant. It makes all of this very easy to manage because they've accounted for all the effects of the depreciation schedule taken. So who has not seen the maker's table? Okay, so you've all seen it. Very good. So then there's some other stuff here. Okay, and the UR tax rate is 40%, so we're going to use that. That's their corporate tax rate. So we need all this information. So that's going to be corporate tax. So you don't remember? Okay, so you guys are going to learn makers. I don't know. I teach it in 3106, but maybe the others don't. All right. So okay, you guys, you're gonna be good. Just giving me an idea that about a third of you so far have never seen it before. Okay, we're gonna work with that. So don't be intimidated by all this. When it says makers, feel relieved, because that's going to help you. So I gave you a makers document. Pull it out and open it on your computers or print it if that helps. Okay, so what we have here is we have to identify what these are. So this is going to be incremental, no, sorry, I've got to be clear. This is going to be treated as an investment. Okay, this is actually going to be called capital spending or initial investment. This is like our CFO, okay? CF subscript 0. Right, that's our initial investment. So that's what we're going to call it. This is the initial investment or initial outlay. Oh, I'm still using red. I'm going to go back to blue. Okay, so the amount, what is the plain price is, where's the plain? 10 million. Okay, so this 10 million is, so you'd like to think, it's a cost, but I'm going to put it as a investment, and then use the opportunity available to me through the IRS to expense it over time and claim depreciation. Okay, so that's the approach I'm going to use. I'm not going to put it in as an incremental cost, so to speak. So I'm going to depreciate from the initial investment. So this is the initial outlay or initial investment. If you can read that, initial investment. And then, depreciation. So we'll underline that. Remember, we're going to depreciate and claim losses. Right, and then we're going to sell the planes. What's the name of this? Does anybody know what we call this? Anybody? Yes, it's going to be I'm going to call it initial investment, and I'm going to put it on a different table. That's why I'm distinguishing, but it is going to be an expense at the outset. It's going to be a negative, right? But I'm going to refer to it as initial investment or capital spending. That's how we're going to refer to it. I'll say capital. It is going to be an expense, but it's going to be, I'm going to do this in a systematic way, and I'll refer to it as an investment. Okay, you guys, what is this amount? What do we call this? I'm going to refer to it as salvage value. You can also call it, I think, residual value. Okay, but whether this is going to be a loss or a gain will be determined by after we've figured out the book value remaining after depreciation. Okay, so there's some, you're gonna put all your skills to use right now. So we call that salvage value, and I'll squeeze it in here. So residual or salvage value. In my notes, I say salvage. Salvage, you can see that. I'll spell it better. Okay. All right, all this information. Now, what else do we have? We have more information. So a lot of the exercises will have elements of this type of problem. Okay? They'll have information. So we have the investment piece. We have the revenues and expenses part. We then also have to consider operating costs. So this is what this table is for. So what we have here are, well, let's call them net working capital. Okay, this is net working capital here. What you have is, because we're taking account of running the plane, like the flights, but so we have that expense. But these are other things that we have to include. Okay, we have current assets and current liabilities estimated. Remember, this is all estimated. I didn't ask you to estimate it, so although you see a lot here, I'm doing you a favor with all this detail. So what you have here are, okay, so we need inventory. So the airline needs inventory. I guess they have supplies. They have things that they need, right? Up front, they have to have $600,000 worth of inventory. So supplies to clean, everything to replace broken stuff, broken things, on the plane, to service, to provide service. So these are all equipment, and not equipment, but things that we use, right, to conduct our operation. So $600,000 upfront is needed. So this is year 0, so that's just like right away, right? That's if you think of your timeline. Then by the end of the first year, you need to end the year with $850,000 of inventory. So you need something extra in between there to replenish and add more in inventory. So you want to keep these levels by the end of the years. You want $1,050,000 by the end of the second, $800,000 by the end of the third, and then by the end of the fourth, you're going to release, or you're no longer going to need inventory. So you're going to move it to your other lines, or you're just going to clean out the inventory stock. So there's not going to be anything there. So this is what you need. These are your needs by the end of each year. $600,000 up front, and then by the fourth, you release those amount, or those supplies, or you don't buy supplies. Okay, so you don't replenish, you don't do anything. You basically close out your inventory. So then cash, you're going to need $1 million up front, a little bit more by the end of the first, a little bit more by the end of the second, and then you do the same thing where you don't need cash by the end of the fourth year, because you're no longer going to conduct the airline to the Bahamas. Maybe you'll consider by that time another project, but you need to wrap this one up. Okay, so you see this is all just a string of zeros. Accounts receivable, you see, payable, and taxes payable. So these are current assets, current liabilities put together in a table for you to compute. What we want to get out of this is net working capital. investment. And so this is net working capital that means investment. Okay, so that's what you want from this information. You want to compute net working capital investment. So what we're going to do is compile all these numbers and then calculate the NPV. You assume the nominal required rate of return for the project is 10%. And you need to answer the question, should you invest? Okay, so all the cash flows, as usual, the cash flows are nominal unless I otherwise tell you they are something else. So this is what we're going to solve. And then we're going to answer this question in the presence of inflation. We're going to calculate the NPV again using real cash flows. And we'll talk about that. Okay. All right, so you ready? So this is our case. Excited? So keep that on the side. And let's look at the notes. So I'm going to repeat some of the things I said. And they're provided in the notes. So pull up the lecture notes, the slides. I put 2 on a page of the slides for you to print it out or to view. Oh, that didn't work. Some of this stuff looks familiar. So it's basically your case is outlined, the solution is outlined here in the notes. So we want to create a projection of cash flows for capital budgeting using NPV. Now I don't have to use NPV, I just taught you a number of techniques, including the internal rate of return, so you could just as well use calculate the internal rate of return, and we're going to learn about that, okay? So what we want to be able to do is value a project. And valuing any assets, like we learned, is a matter of computing the present value of future cash flows against any investment you make. Cash flows are not accounting income or earnings, and you need to be clear about that. So taking that into account, valuing a project is a matter of computing the present value of future cash flows, including net future cash flows, because you might have an initial investment like we do in our UR case. We want to deal with the fact that we're going to make a capital investment, realizing depreciation is not a cash flow. However, depreciation, because of it, we will be reducing our taxable income, and as a result, tax savings will accrue to us. Okay, so those are cash flows, and that's what we have to account for. So just an overview of the kinds of incremental cash flows. So when you read a case, we just read one, but in any of them, you have to go step by step and identify incremental cash flows. It will be incremental if it occurs as a result of accepting the project. No, if it occurs anyways. Okay? So we saw that marketing survey or study that was done years ago would not be considered an incremental cash flow because it already happened. That would be sunk cost. Or any R&D, any kind of research and development expenses previously paid, those would also be sunk costs and are not incremental cash flows. We saw the example of the terminal that now would no longer be rented to others. The market value needs to be considered a loss. We call that specifically opportunity cost due to the project. So this would be similar if there was a machine or some equipment required for a new project of a firm and it was available in the company warehouse. It's in the warehouse, nobody was using it, but it has a market value. We could have sold it, we could be renting it out. So if we take it for our project, it means we've lost there's an opportunity cost to doing that. We lost the opportunity. Same thing with a building. If your office has a building that otherwise you're renting out or using for other projects, so I'm going to refer to operations of a firm often, and I'm going to talk about other operations as other projects of the firm. So if you had a building and even though it was vacant, that's immaterial, that's irrelevant. It has a market value. If you use it for yourself or for some project, if you're considering using it, you have to consider it as an opportunity cost. Side effects. So I mentioned a side effect would be that we're going to lose sales on some flights because our passengers that usually fly with us will fly, instead of going to Jamaica, they're going to go to the Bahamas, for instance. So we have to consider those side effects. Here I have some other examples. So if GMC develops a new SUV, people that previously were buying an old truck or an older SUV will now opt in and buy the new SUV line. What if a company starts advertising a new product, like think about, let's say a company that sells or produces shampoo now develops a special rinse and they advertise effectively about the rinse. So when people show up, well, women do this, I don't know about guys, but when customers show up to buy the rinse, they'll also grab a bottle of the shampoo. So by creating this new special rinse for the hair, some gloss, the customers might buy the conditioner and the shampoo as well. So advertising of a new product will increase the sales of an older product. That's a side effect that you can consider. This is another important one. You'll see some examples of this, something to keep in mind. If the economy has low unemployment, meaning everybody that is looking for a job, most people that are looking for a job, there's only few people looking for jobs. Maybe they're not skilled to do labor kind of job. So factory type job. So we actually, if we're going to start a new project where we need employees with basic skills, we have to attract them from their other jobs. So how are we going to entice them if there's not many people who have the basic skills who are looking for a job? We're going to have to offer them more, right? In the market, you're going to have to offer them more. So you're going to increase the rate, the wage to attract employees to your firm away from others. But you already have employees, right? So you have to across the board, I mean, there'll be problems if you have unions to deal with, or in general, it just doesn't seem fair if you hire new employees for more and the old employees don't make more. So you're across the board, wages will go up. All right, so you're going to increase wages across the board. And that wage increase will continue indefinitely, likely, well, at least for your project, but for your firm, for across all projects. So you have to include that in your calculation. Okay, even though your project would be 4 years, but now you've increased the wage, and the firm is now going to be paying a higher wage to all its employees. All right, so that's also a side effect. So some of those side effects are positive, some of them are negative in terms of cash flows. Then I mentioned allocated costs. And an example, cost of a new library in a research institute will be $100,000 this year. A different proposed capital budgeting project will increase firm revenues by 5% this year. Should $5,000 be viewed as a cost of the project for its share of the library? Well, allocated costs are only incremental cash flows if they're due to the project. I'm not going to deal too much, you're not going to see allocated costs in my exercises, but you can read more about it in the text. Okay, so this should look familiar. We need to mention this. Oh, first of all, I should ask you, do you have any questions? That was a review or a formal introduction to incremental cash flows. So because you're so bright, I was able to cover this material last week. I introduced the relationship between nominal and real rates of interest, that it's a factorial. No, inflation acts like a growth rate on the real rate of interest to create the nominal rate of interest, which is the one we deal with. The main point was, if you're going to have nominal cash flows, you use a nominal rate of interest. If you're going to work with real cash flows, you use a real rate of interest. That's very important. I also showed you the relationship between real and nominal cash flows. And I have an example now that I want to use to illustrate. I think you really got the idea, but I want to show you how we can visualize this. Okay, sorry, I'm just seeing where my formula is. So here's the formula. Here are the two formulas I showed you. The Fisher relation, the relationship between nominal and real rates when there's inflation. And then the relationship between nominal and real dollars when there's inflation. So you've seen those two. So let's look at my example. You start out with $2 million. In financial markets, the nominal rate of interest is 4% with no inflation. In the housing market, however, in Beverly Hills, the nominal rate of interest is 4% per year, but inflation is 5%. So housing prices are increasing. Well, not now, but it's common, but not right now in this pandemic, during the pandemic, but there's usually inflation in the housing market. That's really high, but okay, let's continue. Right now, you can buy a house in Beverly Hills for $2 million. You're looking, you're in the market for buying a home. You have $2 million, and a house in Beverly Hills is $2 million, but the prevailing environment is such that the prices will rise. What should you do? Should you buy the house in Beverly Hills? What's the alternative? Well, if you don't buy the house in Beverly Hills, you're not going to put the money under your mattress. You are a finance aficionado, or you're a finance graduate, and you realize that there's an opportunity cost to put it under your mattress, and that's a lot of bills besides. So instead, you realize if you don't buy the house, you're going to put it in financial markets at a safe return of 4%. That doesn't even exist right now, but if you don't buy, your money grows at 4%. So you're able to put it in some sort of guaranteed investment for a year. And it will grow to $2,080,000. But if you were to buy the house would be worth, at a changing value of 5%, it would be worth $2,100,000. So what's happened? The real value of your money has depreciated. Okay, it's eroded. If you're interested in purchasing a home, you should buy it now, because you will retain the purchasing power. If you don't, you're going to have to think about something else to do with your money. You're not going to be able to get a house in Beverly Hills. You can buy it somewhere else. It's a lot of money, but not in Beverly Hills. Okay, so these are the effects. So I'm going to show you in terms of rates what that looks like. Using the Fisher relation, I can compute the real rate that reflects the erosion effect of inflation. So prices are going up, so you lose if you invest in financial markets. Okay, then I use this as an example. So this is just algebra here to get to that negative rate. So I can show you in dollar terms here. I can show you with a rate, the real rate being a negative, that there's a loss or opportunity cost of not investing in the housing market if you're in the market for a home. Okay, so if you don't care, you're not interested, this is not relevant. But if you are, this matters to you. So I did the calculations here to show you the effect in terms of purchasing power. So buying the home, you retain the purchasing power of your money. And then I just used the example here to show you in terms of real cash flows and nominal cash flows, what would you get? In each case, you're going to get 19,000, but just look at this. These are the nominal cash flows associated with purchasing the house. So spending $2 million today gives me the value of $2,100,000 next year, which I would discount at 4%. So these are the nominal values or nominal dollars. So I mean, I could sell this home for $2,100,000 next year. You have to think about it that way. So that's the value of it. Now I'm going to discount it at 4%. So this is the NPV of purchasing the home in nominal dollars. But as I showed you, as I demonstrated, you should get the same answer if you use real dollars. But what would be the real dollars? Well, it would be the real dollars with the real rate. So here's the real rate that I calculated. Now you'd have to store this value, right, with all the decimal places to get precisely the same decimal places for the answer. But notice for the real amounts, in real terms, I spend $2 million today, and then in real dollars, I still, remember, what does real mean? It means I have the purchasing power of a house. I have the purchasing, I have enough, I have retained the value of purchasing a house. So that's why it's 2 million here and 2 million here. So these are in time zero. So when we talk about real, we always refer to a point in time. So this is 2 million in year zero real dollars. I have to know why it's not in year zero dollars. Okay, that's how we refer to real amounts. Okay, so we get the same answer. So that's a good example for you regarding real and nominal cash flows. In both cases, we have to get the same answer, and it tells us to invest in the home if that's what we are interested in. Otherwise, we lose the purchasing power because of inflation in the housing market. All right. Okay, I'm going to give you a 5-minute break to absorb everything I've just said and come back and see if you have any questions, and then I'm going to continue with these slides. All right, so that's all we're going to work on today, and the slides are just we have 2 hours. Slides are going to be a review of the case. Okay, we're going to answer the case. So let's take 5 minutes. All right, I'm back. Questions? No questions? I will wait to see if someone has questions. Oops, that's not what I want. Okay, so what are we going to do? We need to combine cash flows. So in each year, what we really want, we've talked about, and some students have mentioned profits. That's what we want to get to. We want to get to net, in other words, after tax, operating cash flows. The present value of net and after tax operating cash flows. So net being revenues less expenses. So revenues that we've already seen for our exercise. Okay, I'm just going to go back because someone asked a questions about. So why did I put it here as, so that's what real dollars are. So what I have here is a house, right? I have a house here and I have a house here. I spent $2 million to have a house, and then in year one, at the end of year one, I have the market value of a house. In nominal terms, so these are nominal dollars. In nominal terms, to have a house in time 0, I have to spend $2 million. And to have a house at time 1, which I have, is worth $2,100,000. So that's why it's a negative here, because I have to buy one, and it's a positive here because I have it. Down here in real cash flows, so these are real cash flows. In real cash flows at time 0, because everything in real is related back to time 0, in real dollars, I spend $2 million to have a house. I still have a house. In real terms, what is a house worth at the end of year 1? Well, in real dollars, it's $2 million, because what is real? Real is the same amount of money that I had to buy a house, that I need to buy a house in year 1 as I had in year 0. Okay, so it's real because it's the same thing with the iPad example I explained. To buy an iPad today, I need $1 million. If someone promises me real income to buy a laptop every year, a brand new one, then they're going to have to give me more in terms of actual dollars, nominal dollars, next year. But we refer to it as real $1,000 next year. Okay, so it's real being relative to the first year where I had $1,000 to do what? $1,000 bought me an iPad, so I should be able to buy an iPad at the end of year 1. That's how much money they have to give me. Translation, 1,000 real dollars. That's the same thing here. 2 million real dollars at the end of year 1 is really 2,100,000 in nominal terms. Okay, so as long as I use a real rate, I'll get the same result. I hope that helps. Think about it. That's why I gave you a pause. But yes, think about it. Ask me tomorrow if you still don't get it. I'll try and think of another way to explain it. Okay. So net is revenues less expenses or operating costs, less taxes. What are taxes? taxes are computed. Oh, sorry, let me go back one step. This is called, so I can use the term. So revenues less operating costs less taxes are known as net operating cash flows. That's the top, that's the title, right? Net operating cash flow. So that's what we compute. Now we need all this information. It's very simple to say I need my revenues. Well, there's a lot of things go into that. I need my operating costs. Well, there's a lot of things that go into that. And taxes. Okay, let's start with taxes. How do I compute taxes? Taxes at the corporate rate, that's what that means, the little c. I'm going to ask you, and there's always some students that didn't hear me, but C means corporate. So this is for the corporate case. It is the corporate tax rate. So to calculate the taxes overall, we take our net operating cash flows, revenues minus expenses, minus depreciation. You see, there's no D up here. The D is inside of here. All right, so taxes are revenues minus expenditures minus depreciation, and then we compute the taxes. Okay, so this is like an aside, and then I go back to my formula here. So revenue minus expenses minus taxes, now that I write that like this. Okay, so now I'm going to group together items to get my final statement. So this is in each year we have to do this. All right, we have to calculate net operating cash flows for each year. That's what's going to give us the cash flows for our projected cash flows for our capital budgeting, for our case. Okay, so now what are we going to do? What are we going to do? We will group together. I want to group together net revenue. Well, revenue minus expenses after tax. Okay, so this is what I'm going to do. So I'm going to take these here and factor them out. And that will leave, if you can see that, factoring this out will leave 1 minus TC for that. So what does this say? It's EBDT, which means earnings before depreciation and taxes. And whenever you see 1 minus TC, you should say after tax. Okay, whenever you see this 1 minus TC in your mind or aloud, say after tax. So this is earnings before depreciation and taxes after tax. So even though I put EBDT, I take it off. Okay. So so if tax is 40%, that leaves 60%. So that's what we care about, the 1 minus TC. What's left? And now when we do that, it leaves us, this. How did I get that? Well, all I'm doing is boiling, distributing like that, you see? So that is a negative TC times negative D gives me a plus. We're going to call this the tax shield of depreciation, the tax shield of D. So this is a positive cash flow. Tax shield, tax savings, resulting from depreciation. Okay, so what don't we have? We don't have the R. All we have so far for each year are the TC or the TC. We have to put together all the revenues in a year, the expenses in a year, and we have to find D, depreciation. So that's what we're going to do. And I'm going to do this case. I'm going to handle this case systematically, and that's how I would like you, the method I use is what I would prefer you to use to answer problems about cases. And I give you enough examples and solutions so you get the hang of it. We need to consider these net operating cash flows for income. That's part one. Part two, and I want the present value of income. Let me do that again. I'm sorry. I'm going to say PV of income, right? And I want also investment. I want to consider separately, I want to compute the cash flows from investment, and I need to get that in present value terms. And the third part, I'm going to refer to as the present value of tax shields. All right, so there's three parts. Can you even see that? I'm going to put it up. So there's three parts. First, income. Now, you don't have to do them in order, but separate them this way. Present value of income, present value of investment, and present value of tax shield. Earnings, so he's asking me a question. This is earnings before depreciation and before taxes after tax. As I said, I'd like you to, whenever you see 1 minus TC, you read after tax. One minus TC is after tax. Because it's just revenue. This R minus E is just net revenue before taxes and before depreciation. Okay, so that is net operating cash flow. So we're going to do we're going to compute net operating cash flows for income, investment, and tax shield. We separate it this way because, well, you'll see, investment is going to look different. It has a different tax treatment. So all these elements are separated because they have a different tax treatment. This formula works for income. Oh, this part of the formula. Tax shield is the third part of the formula, and in between we have to deal with the investment piece. All right? So got that? Let's get on with it then. So let's see. I'll look at this after. Okay, so here are the elements of the case. These all should look familiar to you. The facts of the case. So here are some of the numbers you saw already. And I've bulleted them here. Okay, so just a recap. The test marketing, that one is not going to be an incremental cash flow, so we scratch that out. The price of the planes, well, there's $10 million each, so it's 40 million. There's my K, right? Because that's thousands of dollars. So it's 40 million. Just makes it easier to read. Here are the tickets that we anticipate. Here's a ticket price and here's a ticket cost. Then don't forget, we're going to lose some sales. These are lost sales to other lines. So to Jamaica, Puerto Rico, okay? All right, then there's the investment piece. These are cash flows from the investment. Now I have to tell you where I got these numbers from. This is net working capital investment. I've summarized the numbers here and I'll show you how to do that. This is a mention of the opportunity cost of the terminal. A lost $10 million every year. And the salvage. We're going to sell all the planes. No, for each plane for $3 million. And then that is the discount rate and that is the tax rate. Okay, so this all should look familiar because we saw this once before. You might want to read the case again. This is a tabulation of part one. Part one in terms of income, revenues, and costs, here are the revenues from by the end of the first year. Now notice these are all at the end of year, okay? However, people buy tickets all throughout the year. I'm just putting the estimated amounts as end of the year. You can see there's lots of detail, but there could be a lot more if we really wanted. But this is an estimate for us at the end of the year, 32,000. Now that's the 16. If you remember, it was $2,000 a ticket, and 16,000 tickets made $32 million in revenues, and then so on. Now those are revenues, but then there's lost revenues, remember? Because we're not going to sell these tickets. So it was 100 tickets, $2,000 each, so that's $200,000 lost. So that goes in. Oh, Alex is asking, where did the 10% come from? I give it to you. It's in the case. I think it's in the case. You have to check. It's at the bottom or in the question. So the 10% that they're going to use is the required rate of return that the firm uses. We're going to get more into the details of the required rate of return after this week. Okay, now costs. First, we include the opportunity cost of the terminal. Right, because it's market value lost. The variable cost is, remember, this is the expense of running the flights. This is the expense for the passengers of actually delivering the service. Okay, so that's what that is. It was $1,000 times 16,000 flights, 24,000, 30,000. So that's $16 million in the first year, etc. And this, so everything so far is straightforward. You just got to think about this one a little bit, because I didn't mention it explicitly to you, but now it is an effect from this side effect up here. Remember, we're not going to sell 200 tickets in the first year. And because those people we presume are going to buy tickets in the Bahamas line, or they're going to be overwhelmed and not buy any tickets because there's so many choices. I don't know if you've ever done that at the store. There's just so many options. You just say, I can't make a decision. But anyway, they estimate that 200 tickets will not be sold. 400 will not be, sorry, not 200, it was 100 tickets will not be sold. 400 by the end of the second, and so on. Those tickets are worth $2,000, so it ends up being $200,000 lost, $400,000 lost, etc. But each of those flights also had costs associated with operating. So that means that we're going to save on those flights. So even though there's a loss in revenue, there's a gain in expenditure. So this is in the cost section. I would have to subtract this from this. So this will have to be a negative cost. In other words, cost savings. So these are the cost savings of not, that relate back to this one, of not selling those tickets. Okay? Remembering the tickets here are $2,000 each, but the expenses are $1,000 each. Okay, now put it together. So you make a table. You make a table and you compute down, you add and subtract these. And you get going down, you end up with $5,900,000 in the first year, $13,800,000 in the second, and so on. So you have computed earnings before depreciation and before taxes. So now we got to take the taxes off. And that leaves these amounts. So these are the cash flows for income. So these, after all that work, these are what you're going to put into your NPV calculation. You can actually calculate the NPV for this first piece. That's one way to do it. Another way is to take all these cash flows of the three different pieces and combine them in one total project projection. Okay, so I'm going to give you a moment to verify some of those numbers. You see how that works? And we calculate the present value. So we know, so in the test situation, you would make this table. If the cash flows were not so mixed, like in here, these are all the same, they're level, you could actually use an annuity for that. So you might not like the table way of doing it. That, unless I tell you to use a table, you don't have to use a table. Answer questions as efficiently as you can. You'll see when you start reviewing the exercises I gave you, I start using annuities and level amounts. But these are all mixed. So it justifies me, putting them all together in a table and then showing the NPV calculation. Now I just say present value. I'm just calculating the present value of future cash flows for each one. I just got the first one. If you put these into your calculator at 10%, you get 23,691,373. So that is your net operating cash flows, the present value of the net operating cash flows for the project. But that you haven't thought of the investment piece, and you haven't thought of the tax shield piece yet. So we have to do those separately. Are you with me? We're going to do the next two pieces. So the only thing that might stump you is where the heck this came from. Just remember it relates back to this. Sure, you're going to have lost revenue, but then you also have cost savings. Okay. Ready? An investment in net working capital represents an increase in net working capital allocated to the project because we need to purchase raw materials and inventory. We have to keep cash reserves for unexpected expenses and increase accounts receivable, decrease in accounts payable, and taxes payable. And I gave you some numbers. I gave you what's referred to as the net working capital requirements. So up front, you need $1,600,000. By the end of the first year, you need $2,400,000. By the end of the second year, you need $3 million. So these numbers I give to you. By the end of the project is over. You don't need anything. You don't have to replenish your raw materials inventory. You don't need cash reserves set aside. So you release those funds associated with net working capital requirements. So what we need from here are the investment. So from the perspective of the firm, we have to do this in a couple of steps. I'm going to actually, so I put them vertically here, but I'm going to do this horizontally to show you. So let's put these together. Inventory, cash, add accounts receivable, subtract payable and taxes payable, and compute these amounts below. Okay, so computing those amounts below, if I put these all together, I call this net working capital required. I get $1,600,000. I can just put a K. And this, by the end of the first year, I need $2,400,000. By the end of the second year, so all I'm doing is adding and subtracting to get these amounts. So can you finish that table for me? I need more space. So it's going to be 1,600,000 and 2,400. Okay, if you can follow. I wrote them really nicely in the notes. So you get the idea. So now what? Those are the net working capital required. Net working capital requirements. Now what I do is I need this amount by the end of the year. Well, right now. And I need this amount by the end of the first year. So how much more do I need? What's incremental because of the project? That's what I'm really interested in. So for year one, the project's just starting, so that amount doesn't exist. So I'm going to need $1,600,000. Now between today and next year, I need an additional, how do I figure that out? Next year's amount minus this one, I need an additional $800,000 to satisfy my requirements. In the next year, from $2,400,000, I need $3 million, so I need an additional $600,000. So you guys get this? This is incremental. These are incremental cash flows. That's what I need for my analysis. In the third year, I'm going from $3 million going down, right? So we're starting to release funds. We don't need so much because the project is closing out. It's coming to termination. So that means I will release $800,000. And I ran out of space. Let me do that again. So I'm just going to put it down here. So then I need $800,000 by the end of year 3. And then between year 4 and year 3, I need nothing in year 4. So I am going to release the $800,000 by the end of year 3, and I will release what remains, $2,200,000, by the end of year 4. Sorry for the mess. I have it neatly done to avoid this. The main thing is to realize how to make the calculation, okay? That's what I want to get out of this. So this is called, I refer to this as networking capital changes. So these are the networking capital changes. So that's how much we need. Finally, from the perspective of the firm, looking broadly at all of the projects of the firm, this one is going to need investment. So I need to reflect that in the cash flows. Right now, these are just looking like networking capital, requirements, change. This is what I need, which is how much more I need. So these are incremental cash flows. However, it's not reflecting the fact that the sign is wrong. This is an investment. I got to put the money there, right? So the funds have to be allocated. $1,600,000 is an investment. $800,000 is an investment. These are negatives. So these ones are negatives. And let me show you the cleaner example of this. I have way too many things. So in red, it's better to look here. So here's what we did calculating by ourselves. Now, investments, basically I'm changing the sign. I just made this a negative, that a negative, but here's where it really hits home what you're doing. So now, this is what I talked about, releasing the money from the project. So this is coming back to the firm. So in red, what you see are the incremental cash flows for networking capital investment from the perspective of the firm. If you don't understand anything I said, just remember it's 3 steps for now until it sinks in. 3 steps. First step, add them up. Second step, look for changes. Third step, change the sign. I prefer you not to do things in steps, but it might just help us move on for now, and you can go back and think this over. So these are investments, and then these are funds released. Released back to the firm for their other projects. Whatever else they have up their sleeve, what they're doing. Ongoing operations. Okay. So we finished one large portion of investment, but we have another part. We have to take care of the planes. We haven't accounted for the cost of the planes yet, or the tax savings from the planes. So let's do that. This is how you do it. You set up a table. This is a table. So go to this slide with the table. And I've included the facts you need for this table. Now this table works together with the maker's table that I share with you. So pull out the maker's table. In the maker's table, identify the column for 7-year period of depreciation. So the idea is planes belong to a class for depreciation. So there are all types of assets, physical assets, that the IRS allows you to expense for depreciation. So lost wear and tear over time. So you get to claim, you're claiming the expense, you're saving from your taxable income. You're not paying taxes because of this. So this is an opportunity. Okay, now if people don't do it, that's another thing, but this is an opportunity available to anybody who purchases assets to save on your taxes. It's an incentive, right, to buy stuff too. That's the idea from the perspective of the government. It gives you a bit of a boost when you think about purchasing. So what you have here is information about which column to use. I told you just use the 7-year depreciation. So those are a class of assets for electrical equipment, large electrical equipment. So I'll tell you which class your asset belongs to, but in life you're going to have to figure it out, and that website for the IRS provides that information on the maker's table. Let me grab the just so you can see it. Together. So in this table, it's been, all the features have been computed into the table. One of those being the half-year rule. You know what the half-year rule is? So this is ours, the 7-year. This is the one that we're going to use. Now there's 7 years. Goes all the way down. Uses straight line depreciation, and it's figured out the rates. Now notice the first one is smaller than the second one, and then it starts to decrease. And that's because of the half-year rule. That happens in every case. And the half-year rule is that in the first year, you cannot depreciate the full value of an asset. You can only depreciate half its value. Okay? And that is an attempt to guard against companies who took, whose staff or finance department took finance and understand that if they didn't have that rule, companies would buy all their equipment on the last day of the year, so December 31st, and then for their taxes be able to depreciate their asset for the entire year. So they have a relatively new thing, but are able to claim depreciation for that thing. Now, this is not perfect, but it's a discouragement, from doing that. At least they're not allowing you to. You could still do that. You could still buy things on December 31st, but you only get to depreciate half the value. Okay? So that's all put into there. And then the method of depreciation has already, all that stuff has been calculated into these rates, and I'll show you how to use them with the table. All you need to know is which one to pick up. That's it for this class. But in life, you can use this method too. Oh, I'm just going to look here at the case. So this is where a student was asking, where did it say 10%? It's in question number 1 at the bottom of the case is where it says the discount rate. So it referred to it as the nominal required rate of return for the project is 10%. So again, identifying the rate, you will see the terms used: hurdle rate, cost of capital, required rate of return, risk-adjusted rate of return, these are all the discount rate. It's all the same thing. Discount rate for valuing cash flows. That's how you use it. I mean, they're derived by the way they're termed, but you use them all in the same way. They're the R or the I interest for your formula. Okay? If you come across others, you can let me know. I think those are the most popular terms. Cost of capital, cost of equity. So for a firm, that's doesn't issue debt, just issues equity, we would call it the discount rate or the required rate of return, the cost of equity. So those are all the same thing in terms of our formula for valuing incremental cash flows. Okay, take a screenshot because I'm going to go to the next. Here, take your screenshot if you need it. Okay. And back to the exercise. Let's work with the table. So we will take for the maker's table, we're going to put here the depreciation. Now notice, even though it's a 7-year depreciation schedule, we are only going to use the first 4. Is that all right? So don't let that blow you away if you realize it one day at night when you're studying for the test the next day. You think, well, why aren't there 7? Because our project is only a 4-year project. So the schedule that you choose has nothing to do with the length of your project. You don't pick the 3-year one because your project is 3 years. You don't pick the 4-year one because your project is 4 years. You pick the one that I tell you to pick. And I'm just copying now from the 7-year schedule. I have to make this bigger. Right? And then 0.245, and then 0.175, and 0.125. So those are the rates. D star, little star, little d star, minuscula. So follow the headings of the column to guide you. To figure out D in the first year, 1 year of depreciation, all the things I mentioned to you, the schedule and the half-year rule is all put into this number. So all you've got to do is take little d times 40 million. So that's the total value of the planes. So by the end of the first year, we get to claim big D depreciation. So multiply 40 million times that amount and put the number here. All right. And we're going to go across. So when you do that, you compute 5,720,000. So that's how much you get to depreciate, almost $6 million. So you get to save on the $6 million. We'll calculate the savings in a moment. First of all, we need to figure out the UCC. UCC is the undepreciated cost of capital. So UCC is the undepreciated okay? It's the undepreciated cost of capital. So how do you figure that out? Well, what's left on the asset? Well, 40 million minus the depreciated amount is what remains of the asset for tax purposes. And you have to put that number there. So I'm going to squeeze it in. That's 34 million I'm going to show you the nice version in a bit. 200,000. So that's what goes there as remaining. Okay. And the tax shield, you figure out all you have to do for the tax shield, and this was determined, remember, in the first calculation of net operating cash flows, we found this term, TCD. To figure out your tax savings, all you have to do is take the amount you're expensing and multiply it by the tax rate. So all you've got to do is take 5,720,000 times the tax rate, 2,288,000. So you're saving in the first year, because you were able to depreciate and you chose to do it as a class 4 asset, you saved $2 million, or UAIR did. Okay? So how do we complete this table? Let's look. I have the calculations here. The way that the next value is computed, tell me how the next one is computed, the next column. So how did I get this? How did I get this? Let's just do this one first. Okay, how do I get that value? Did I get a different number? Yeah, no, I got that number. The tax shield. So to get the tax shield, you just follow the formula. The formula says D, which is this one, times 40% or 0.4 to get this. Try it again. So 5,720,000 times 0.4. Okay, good. So I see that there's conflict. So this is really important that you know. The maker's table is amazing in that all you have to do every single time is compute D times 40 million. The table's already taken care of the subtraction. So it would be intuitive to say, well, this is left, so I would multiply that by the next rate. Well, the maker's table actually has made that calculation for you. So all you have to do is always repeat this calculation. It's just the first column times 40 million all the way down. Okay? So the makers has already accounted for that for you. Yeah, all you have to do is D times 40 million and then D times 40 million. You could derive these yourself using the rate 28, whatever it was on the case, with straight line, however it mentioned to do it. You could derive these and then also include the 1 minus to take account of this new value. So when you use makers, all you do is D times 40 million. Try and remember that, make a note. We still need this column though. Why do we need this column? We need this column because we want the book value. What remains of the asset value from perspective of the IRS That's what we need. So that's why I need the third column. So let me give you a moment to get all those values, confirm all those calculations for yourself, and then we can move on. Let me know if you need any help. So the makers table I gave you includes all of the schedules you will use. In some problems, I give you a different schedule, but it's still like you still use it the same way. It's just a matter of whether I have 3 decimals or 2 decimals on it, okay? It's because the book from the Gitman book used in 3106 had a table with only 2 decimals in it. And so some of my exercises I developed with the Gitman book, and some of them I just used the IRS 3 decimal places. You can find calculators online too that will help you make all this calculation. But if you just remember the headings, it's quite easy. I'm here, I'm just going to look at something. Just let me know if you need me. I just wanted to mention, well, I'll mention at the end about the test. If you have any questions about the grading of your tests, please let me and the grader know, and we'll look at it. Okay, make sure you review the clave I sent and that it makes sense to you, right? Yes, the D will always be from the makers table, or I'll give it to you and it's going to be used this way, from like it's coming from the makers table, just a makers table that had 2 decimal places rather than 3. Okay, so that it's funny, it's, you know, I taught in Canada, that's where I'm from, and they don't have nice tables like this. Everything seems easier in the United States, a little more complex over there. Maybe I'm smarter now, I'm not sure, but it just seems a lot much easier to use tools, much more user-friendly in the US, I'll tell you that. So this is, you can do this also for your planilla here. I'm using the IRS schedule because I believe in Puerto Rico it's also the IRS schedule that you would use, okay? It's the same because it's the American federal tax system. Okay, so why is this called the book value? Yes, because I'm calling it the book value. It's at the end of the project. This will be the book value. All these would be the book value in their own year, but this is the book value at the end of the project, which I really need. I need that number. I need that number because I have to know how much the planes are worth in the books. Okay. I'm gonna wait for you guys. Okay, I'm waiting for you. Okay, so it looks like you guys got quiet. All right, so you get this table. Very good. So we need from here, we need this amount for the investment piece, part 2. And we need the purchase amount for the investment part. And this goes into part 3. Okay, so I'm just telling you where we're heading. This is for part 3. And this is for part 2. So that's how I'm going to use this information. So I went through all of this just to get these and this. So obviously if you make a mistake early on, you're going to have the wrong value here. So what the grader will do is deduct mark like maybe a half a point when you make an error in here, and once you make it, it's going to mess up the whole table, so he'll just penalize you once. But if you do something else strange, you'll lose another half mark. And then you'll get the final. Once you get the final one, he'll have to recompute with your wrong final value and make sure your calculations were right. I think the grader did a fantastic job grading and giving you guys credit for intermediate errors. Well, not penalizing you for intermediate errors. Okay, so what do we have? I think I had this. We're going to put this together. Oh, I have this again. Okay, so we need to talk about something. So the book value. What do we do with the book value? I'll give you a little equation here you're going to put on your formula sheet. Put this equation on your formula sheet. This is what we're interested in. We need to figure out we have to figure out what is the impact of the salvage amount. So what is the impact on our, in terms of cash flow, because we had a plane still, some parts of a plane or a plane. We have quite a bit of the value of the plane left. So we can sell it, actually. We find we can sell it, or we anticipate we're going to be able to sell it. However, if we sell it and the book value is more than the salvage value, the market value, So it's called the salvage value because it's what we can get in the market. So residual market value, supposed to mean the same thing in this context. So if the book value is more than the salvage value, that means we're not getting as much as we have accounted for in depreciation. So from the perspective of the IRS, that's a loss for taxes. That's a capital loss, and that's something you can claim on your taxes. You can claim a loss, just like you claim expenses, all right? If, however, the book value is less than the salvage value, you have to pay capital gains taxes at the rate of capital gains tax. All right? So this looks very, very complex at the outset, but it all falls down to this formula. Use this. In any case, in the year of the sale, add to the investment portion, which I'm calling 2, part 2, the cash flow of the present value of this amount. Salvage plus the tax savings or the tax payment for this minus this. So this number will be a positive if the book value, you're not able to sell it for as much as you have in your accounting. Like you value in your accounting record, the book value is much higher, so you haven't completely depreciated the value from the perspective of from your perspective, and the market is going to give you less. So you get tax savings because of that, this being higher than that. If the salvage value is higher, though, you see this is going to be a negative inside, and then that means, so if salvage is bigger than book, that's going to be a negative. You'll have a negative, and so you have to pay taxes. Got it? You pay taxes on that difference. So if they're the same, there's no extra portion here. Okay, so if they're the same, there's no extra. In the your case, the impact of the salvage of the fixed asset on the NPV of the project is exactly the present value of the market value, because it turns out that in our case, the book value, which was what? The book value was $12,480,000, right? Well, what was the salvage we estimated? We estimated a salvage, or we were told to estimate a salvage of $3,120,000 for each plane. We'll multiply that by 4, and you see that the salvage is identical to the book value. This is the same number. So I made the problem so we don't have to worry about this, but all the other problems you still have to check. Okay? So I just took this extra bit out for this problem, but you don't have any extra, but just the cash flow at the end of the project, year 4, you're going to get $12,480,000. You need to discount that. So let's see, let's put this together now. So I've discussed all this stuff. You're going to have to review it. You have lots to review. And now I'm putting it together. So this is the second piece. We have the planes. These are the net working capital investments. I should put the word investment. Okay, so these are the investment amounts. Remember these numbers. So I put those together as total investment cash flows. So that's the second piece. What I added here was the salvage for the planes in year 4. If I also had the tax effect, that would all go in here too. If it's a loss, I get tax savings, I'll get extra, it'll be higher. If it's a gain, I have to pay taxes, it'll be lower. But it all goes there. So all that work just to find that number, but it's important. These are big numbers. So we got this. So these are the cash flows for part 2. And finally, the tax shield. This is the last column of the depreciation table. I put them in here, and they also have to be discounted. So I can discount them separately, or I could put them together. This is the present value of part 2, this one. And this is the present value of part 3, the tax shield. So you guys are good with that. You can put that in. Now they're mixed cash flows. You have to enter them to the net present value formula as mixed cash flows. This one can go in as, you have the first value. Here you have 0 in the first year. So notice, that's all I do. I'm dealing directly with the taxes here to calculate this number, all that work to get that number. I've already done the tax treatment, okay? There's no after tax, there's no 1 minus TC here. Similarly with the tax shields. The tax shields are the savings from taxes, so that's how taxes have been dealt with here. So I just take the values right out of the last column of the table and discount them. So all these values are the same discount rate because these are all cash flows relevant to the project, pertaining to the project and the firm. And now we put it all together. So in the bottom I have all 3 amounts. This is just a repeat up here of what I just did. So I have all 3 parts. Calculating the net present value of the project at 10%, 23 million from part 1 income, 32 million negative from the investment because this is the expense, you know, what we spent to buy them, and then operate, net working capital, assets minus liabilities, and then in here also is the salvage for being able to sell the plane. All of that is in here. The sale value doesn't offset the cost so much because it is in 4 years' time, so it's a smaller cash flow from the perspective of today. And these are the tax shields. We save almost $9 million in taxes because we're able to depreciate for wear and tear of the planes and claim that on our taxes. All right. That's it. Put it together. It's a positive. You should invest and accept the Bahamas project. That's it. That's a lot of work. It took us the whole class, 2.5 hours. So you need to get good at this. I gave you several exercises. You can practice. I think I gave all of them to you. Yeah, I gave you a bunch. Okay, so I gave you the answers so you can read through them. Try and read the case. Tease it apart first before you look at the answers. Otherwise, you won't appreciate what you're reading in the answers. Okay? You're not evading taxes. It's the law. Okay? But yes, it is a beauty. You know, you always need to think. Always. I mean, you guys are finance students. You should always be thinking of the tax treatment of everything. You know, how can I save? And again, these taxes, this is the law. People can call it shady if they want, but it's the law. And if you don't know it, you can't take advantage of it. I think a lot of people who, I think about myself. I could probably be wealthier if I knew more about how to manage with revenue services, you know? A lot of people take advantage of all the like this whole thing that happened with the pandemic and also with the Hurricane Maria. I know people, because of knowing all the rules, made so much money because they had properties that they didn't have to pay mortgage on, and then they didn't have to pay certain amounts of taxes, and then they made so much money. I know someone who had 19 properties that they didn't have to pay mortgage for. Imagine the revenues over 4 months. So yeah, if you don't know, it's going to affect your valuation of your assets. It's going to affect you. So accounting is invaluable. I didn't become an accountant. I always have a good friend who's an accountant who helps me out. But I realize the value now. I wish somebody had told me in the past that accounting isn't just about sitting there at a desk. It's about making money by saving. Okay? So, yes, it is beautiful. Okay, so let's see. Just one other point. I could have taken those cash flows from the 3 different parts. So the cash flows that I had put boxes around, and I could put them all together here. So this is the first box for part 1, the second box part 2, the third box for part 3, and I could have put them all together and then evaluated these cash flows. This is known as a total project cash flow. See, I didn't do that until now. I did it 3 separate calculations of the NPV, or the present value of those cash flows, and then added them together. This way, it looks more like what we've been doing till now, where I give you the cash flows and you tell me the IRR, you give me the NPV, something like that. So this is more familiar to you, but I think it's much more efficient to do it the other way. Transcribing all these numbers leaves a lot of room for error. So going from pages of calculations and transcribing here, and then pages writing this, and it's just too much. Okay. Let's see. So here, I ask you, well, you're going to get the same number, obviously, and you should invest the same answer. And I ask you now that you did it this way, that the beauty is you can use the total project cash flows to calculate the IRR, which is interesting. I mean, you still know the answer. You still know you should invest, but it would be nice to get, like, again, how do I know if I should use 10%? Maybe it's not the right answer. So this will give me a range of values where the project is feasible. So, well, did I do it? You guys are going to do it for me? Okay, do it for me here. Calculate the IRR for the project using these cash flows. Remember, these are just putting them all together, part 1, 2, and 3. What is the internal rate of return, and how do we interpret it? Okay. What'd you get? Nobody yet? Find me the IRR. That looks right. That looks right. So remembering how to enter this into your calculator. I know we learn a lot of things. Make some notes about what you're doing. To enter this into your calculator, remember these are millions of dollars, but as long as they're all rounded to thousands of dollars, you should be able to enter them this way. You know, you should be able to put these into your calculator just fine because they're all in millions of dollars. You don't have to put the triple zeros with extra zeros. Keep going. I'm waiting for more people. Remember, to clear your CF functions, you have to hit CF first and then second clear work. Okay? You have to be in CF first and then second clear work. Otherwise it won't clear. So you have to, in fact, you have to be there. So make sure you do that. And it's clean. $10.256. Very good, Alex. Everybody, Laura, Monica, Brenda. Okay, so you just follow the rules. And this one, you know, just 2 decimal places is fine. But usually follow the rules on any assignments that I give you, or any of the notes I give you, questions I give you, and the test. Follow the instructions. But yeah, it's 12 point. I'll put it in 3 decimal places. Oh, sorry, not 12 point. 10 point. 10.256%. And because it's higher, it means that we overshoot our required rate of return. If required rate is 10%. Uh-oh, I just turned off my iPad. Sorry. So since the required rate of return, since the project rate, the internal rate of return, is greater than 10%, we accept the project. Same conclusion. That's the required rate of return. We accept. Same conclusion. The difference is that we get a sense of, you know, it's not that much higher than 10%. Okay, that gives us an idea that, you know, if we were considering using a higher discount rate, we wouldn't accept this project. It wouldn't be worth it. We would be discounting the salvage way too much and future cash flows way too much. Okay. Did I just say that backwards? I think I just said that backwards. Let's see if I can say that again. Okay, so we got 10.25, which is not much, right? And if it was smaller, it wouldn't be high enough. That's right. That's what I meant to say. 10.256 is just over 10%. It wouldn't be high enough. Okay, that's all I wanted to say. Okay, so what next? So there's a couple of other slides here where I just show you what if the rates are real. So why would you do this? Well, again, the emphasis, why do we use real rates? Because when I look at these are the real rates. So I've accounted for inflation here and used the formula to do that. And these are now real cash flows. So when I look at these numbers, they've been adjusted for inflation in that when I look at them, I say, well, at the end of year one, it's $3,403,000 in real dollars. It means to me that whatever I could buy with $3.5 million today, I could be able to get in year one. That's the purchasing power. It shows me the, it shows me that there's, if I compare it to these values, they're really similar. They're not that different, but it's more meaningful to me when I look at them. Okay? And that it's not just obscure. I'm not looking out into nothingness. I know what $3 million means. I know what $7 million means. And all of it hinges on whether this is a good estimate of the inflation rate over the future. But anyway, that's what it is. So if I was to actually evaluate these, I would have to use the real rate of interest. So I would have to compute it, which I do here. Okay. And I continue to do it with the 3 steps, and I get the same numbers. It's as long as I use the real rate with the real dollars, and then I just put in here the tax shields with the nominal rate to show you I still get the same answer. Anyway, you have to get the same answer as long as you use the real dollars with the real rate and the nominal dollars with the nominal rate. Is that it? It's 11:41. You have all of the materials for this week. It's only Tuesday. So what should we do? Tomorrow, I guess I'll just take questions tomorrow. All right, and then you can tell me what you want me to cover, because you have everything in your hands. Like I said, maybe if you really have time, I'll give you some more. But basically, those are the kinds of questions that you'll see on the test on Saturday. So tomorrow I'll take questions from you. If you don't have questions for me, or if you just need time to study, what I'll do is I will work ahead and teach the new material after Tuesday, so for Thursday and Friday. And if you don't want to look at it, that's fine. You can just look at it on the weekend. But I don't want to waste time. And maybe that will be good, because it'll make up for the next Monday and Tuesday that I'm not going to lecture. So that might work out. But if you need me for the rest of the week to keep solving problems with you, that's fine too. So just let me know what you need tomorrow. Have a look at everything, and we'll talk tomorrow. Okay? So, bye-bye.